Hope you guys hear me. I apologize for the delay. The call is happening indeed. So let's start with the situation around Iran and Hormuz, the Strait of Hormuz in particular. So Iran is reportedly charging $2 million, $2 million per ship that will cross the Strait of Hormuz. Then the question is, how the payment is being collected? Well, the payment is being collected in yuan, but also in crypto. So this is the article from Yahoo Finance as of last week. It goes like this: Iran has established what amounts to a formalized toll system in the Strait of Hormuz, accepting Chinese Yuan and crypto, specifically stablecoins pegged to fiat currencies. Okay. This system, administered through Islamic Revolutionary Guard, corpse-linked intermediary, assigns each nation to a friendliness ranking, 1 to 5. It requires vessel operators to submit documentation for geopolitical vetting before receiving blah, blah, blah. Okay, cool. So that's how they vet it. Perfect. Now, we suspect this represents something structurally distinct from the informal blockade enforcement that characterized Iran's earlier Hormuz posture. All right, so this article is essentially exploring the fact. Let me just get to the gist of it. So the currency structure is deliberate as far as how the payment is being what the payment is being accepted in. So yuan settles outside the SWIFT-dependent dollar clearing system entirely. Okay, so and U.S. has been known for closing SWIFT for a number of clears in the last 5 years. In particular, well, Iran has been under massive sanctions for 40 years now, so they have not been part of SWIFT, and of course, payments have been an issue. But let's just continue. While stablecoins, if denominated in Tether or Circle, technically reference dollar value but transfers on blockchain rails that bypass correspondent banking. And now we talk about crypto, right? Let's not forget about this. And of course, what is the conclusion? That is precisely the architecture that OFAC has been attempting to close through pressure on stablecoin issuers, and precisely why the Hormuz toll mechanism, if it scales, creates direct enforcement pressure on Tether and Circle. Well, first of all, despite the fact that, well, while Circle is sufficiently regulated, Tether has been an issue amongst the crypto community around Tether for quite some years now. And as you know, nothing has been done. So Tether is domiciled outside of the US, but magically, Tether is like approved everywhere, and not a single regulator went after them. Not a single time. Like, there's a huge question whether Tether indeed does have all the necessary funds back in its, its issuance of, when it's like 1 for 1. There have been some rumors that it's maybe 70% only is backed, and the other 30% is not backed. Now Tether is trying to do something, trying to hire some type of auditor, but is it real? Is it not real? So all this funny stuff. And given the fact that Tether is such a big player, and given the fact that there are so many, at least rumors oriented, so many, red flags, nobody went after Tether. Nobody. While enforcement agencies did go after a bunch of other projects, including Uniswap, including MakerDAO. Back in the day, although those charges have been dropped, Aave, I think, also was gone after, and that is so much in the clear. Okay, that's like a question. Obviously, kind of what I'm thinking specifically is, yeah, Latnik Kenta for transparency. Exactly, permissionless goals. That's exactly right. Like, my personal thing is, it's being covered by some big, very, very big boys, super big boys, and do not even come close to those big boys. And yes, it's a part of the national strategy to ensure that the world is still dollarized. And while, in this case, based on this article, Iran could potentially be using Tether Circle, they're still part of the global dollar system, and that's the most important part. Right? Like, yeah, SWIFT cannot work, but as long as everybody's still using dollar, as long as the dollar is still the dominant currency for petro transactions, thus establishing or re-establishing the petrodollar, we are good. And therefore, of course, there's some really, really big boys on the background connected to the Federal Reserve to make sure that the Federal Reserve strategy is in line with, the strategy behind Tether. So Are these guys self-made entrepreneurs that magically making more money than Goldman Sachs with whatever they have? 30 people. They're so genius, and I really freaking doubt it, guys. Like, I mean, maybe they are, but again, please explain to me how come nobody ever went after them. But while the article on Finance Yahoo, if this article was written 5 years ago, this article would have said, "This is the power of crypto. Let's go." Yeah, we can have whatever opinion we can about Iran, good, bad, whatever, unknown. But crypto is enabling the freedom of payments, however it is. It's not for us. We don't have the necessary. We don't have all the ins and outs of the story. We don't know who is right, who is wrong. In fact, this war in Iran, yeah, amazing, very, very bad regime, very, dictatorial, etc. Yet this dictatorial regime is somehow surviving the war, while literally every single, major general and every single major political uh, influencer has been killed through targeted attack by U.S. or Israel. Yeah, this dictatorial regime is somehow surviving. Yeah, probably has to be very dictatorial, right? Like if they removed every single potential candidate for dictator and the regime is still operating and still kicking. Okay, but this time it's a very different, kind of thing. It's like it's inquiring, OFAC, you guys not doing your job. How about we do more KYC? How about we do more, more regulations on anything crypto? And that is a very, how to say, thin ice regarding the crypto space. And that is connected directly to the bridges. We'll touch upon this in a second. Now, the second article by Bitcoin Magazine, published a little bit later, now talks about Iran to accept Bitcoin for Strait of Hormuz transit as ceasefire takes hold. And somebody is associating this article, this fact or this rumor with the fact that Bitcoin is actually up from $66,000 now to $72,000, whatever. Why? And then there are all these tweets going around the Twitter, where they say, okay, it's about like 400 or 500 bitcoins, new bitcoins emitted every single day, and of those 500 new bitcoins, half of it is what Iran needs to accept for its oil exports. So because Bitcoin is so scarce, and you cannot mint more of it, there's nowhere but up, because just Iran alone, just Iran alone right now, if it's going to be accepting bitcoins, half of all the daily supply will be just going for that. So imagine, like, if something else happens, like in Southeast Asia or Latin America or North America or anywhere in Europe, and more nations being banned, that would just add up to this overall kind of buying pressure, right, in bitcoins, while the supply is the same, 400 or 500 per day of new bitcoins minted, but that kind of new emission is only decreasing with halving every 4 years. And of course, there are some questionable comments around tweets like this. Some say yes, let's go. Some see people say, oh, Bitcoiners and all these crypto guys, they're so out of out of their minds. They do not have any other way to sell this revolution of crypto. Like come on, guys, like it's 2026. Forget about this stuff, right? Like it's all institutionalized. And that's of course a huge question. For me personally, like, what's the point then of crypto? Like, if crypto is regulated, what is the point? And of course, the likes of Circle and Tether say, hey, listen, or the likes of Chainlink, the likes of Solana, they say, hey, listen, cryptocurrencies are there just to make stuff more efficient. Okay, so we have this archaic banking system that is, was supposed to create the end of the world, from 1999 to 2000, because those numbers were switching, whatever, right? The system is so archaic. Now the banking system cannot be changed because all these databases still, kind of possess all this historical user data. So you cannot just go ahead and magically renovate, kind of the SQL, or some people using these like super old languages. Now it goes back to this other statistic that was very, very popular about 10 years ago, how much European banks spend on IT versus how much American banks spend on IT. And European banks spend like 2 or 3 times more on infrastructure redeployment. And therefore, the likes of whatever UBS and Credit Suisse and Deutsche Bank and like, whatever, Barclays, all these European banks are so much better as far as tech versus American banks. American banks are, pain in the ass to use, like use all this like archaic stuff. And then you have this crypto stuff, right? That is settling without not 2 plus 3 days, but it's like within, seconds, within blocks. Like stuff just settles fast. And that is the use. That's the utility. The utility is fastest settlement. That's an argument. But like, how to say, that is true, but if this is the argument, and yes, the banking system could potentially kind of, get faster, but why would these startups not be acquired by the banks? And the whole point is, what is so special about crypto? Like, why are we so, how to say, like, it's kind of like cutting all the important things and just leaving the, kind of the necessary things rather, right? So, okay, so the blockchain layer can absolutely result in faster settlement. Congratulations. But then if you do have tokens and, slash coins, why don't you guys, like, JP Morgan of the world, Goldman Sachs of the world, Circle of the world, why are you guys minting your tokens, right? If there's no point in, how to say, if everything is just settlement, don't do tokens. Don't give it to our hands, right? Like, don't monopolize on, on self-custody, because that is what blockchain is. But you guys are going with the self-custody, but at the same time, you can freeze any addresses, you can do whatever, right? In Circle, that functionality is a lot more developed than in Tether. Tether did not start with that. By the way, talking about how the vision was that. No, Tether's vision was not that. Tether's vision right now, by the way, to freeze accounts is so much more limited than Circle, because every single account or every single list of accounts that is being frozen significantly adds to the overall transaction fees for everybody else. So Tether has a list of addresses. Yes, they can blacklist these addresses. However, the more addresses that are being added, the higher the loop that every single transaction has to go through in order to make sure that, okay, like, if, user A transfers to user B, let's, first of all, before this transaction goes through, first of all, let's scan through all the addresses that are blacklisted. Now, the larger that list, the higher the transaction cost for user A to transfer to user B. Like, it's crazy like that. So, like, that's just to tell you that Tether was not initially architected to freeze anything. Circle was. That was like the deliberate action, but Tether wasn't. Now, Tether future deployments on some chains probably have, this thing fixed, but all the oldest deployments on Tether and Tron, I believe, are, very much anti-blacklisting stuff, at least architecturally. It's possible, but it's, again, very costly for everybody on the network. And Tron fees in particular are very, very expensive. So good luck doing that on Tron in mass. And that's where Tether has the most adoption on Tron network as far as actual utility. So that's just to tell you that all these like things about KYC, that's just a bullshit response. Well, not a bullshit response. That's a necessary response, but it's bullshit, like as a characteristic of that response. It's a total bullshit, nonsensical thing, because governments all of a sudden started just getting everybody, in their, iron hands to squeeze out any freedom and to increase total control, and which was completely non-architected initially. Tether, I believe, was started out around 2014, if I'm not mistaken. Okay, and 12 years later, now they're also pervading it as like, oh yeah, let's do it, let's KYC everybody. There's nothing wrong about KYCing everybody, but that's not why crypto is crypto. Now, crypto is definitely there. The blockchain technology, they're absolutely for faster settlement, real-time settlement, trustless architecture, 100%. But it's also about the economics, rather like the socioeconomic factor. And that's why the likes of Hyper Ledger and the likes of R3 went bankrupt without seeing any day of flourishing due to the fact that they did not have a token. So they just said, hey, listen, at least they were honest. They said, listen, screw these, like we're going to go corporate route. Screw the tokens. We don't need tokens. We're just going to proceed with amazing architecture that is trustless. But then the question is, okay, if the architecture is so trustless, who is spending or rather receiving any profit for maintaining the goodness in a trustless fashion of such architecture? And the only way to do that is by giving somebody a token. So it goes back to the root. Like, listen, I'm going to be earning Bitcoin on my network, and that is my motivation to make sure that I am acting in good faith as a decentralized trustless player, meaning as a miner, as a validator, right? So that's why the token is such an important part. And when Circle comes back and says, for example, I'm not saying that, but like if that is the argument, hey, listen, let's, screw the token. It's all about the blockchain technology settlement, fastest settlement itself. Okay, erase the token then. But we do have projects that did erase tokens. Again, Hyperledger and R3, and they are bankrupt because there's no socioeconomic factor to make me a good actor as a validator to maintain the network. So fortunately or unfortunately, these things are connected. You have to have a coin or token. The token coin ideally has to have enough utility for everybody to use it. And then, of course, that token lives on top of the blockchain infrastructure that is, yes, fastest settlement, which is a cool feature, but that's not the main feature. The main feature is to give something that people own into their hands that ideally has value or not enough for validators to maintain the network on which that something lives on. That is kind of the idea. Okay. And of course, like, we just see how the the industry switched completely. Okay. So what's up? So how is that like related to anything Ghost does? Okay, so you run, accepting payments, and some writer over there has no fucking clue what they're writing about says, hey, let's OFAC, like control everything about crypto. Okay, cool. But then, for whatever reason, we have this article from CoinDesk. DeFi yields are crashing so hard that they cannot compete with traditional savings accounts. No shit, really. And let's see what they like. What this article is like absolutely real. I'm not laughing at the author. I'm just laughing at the aftermath of what happened. DeFi yields have collapsed below TradFi rates. No shit, forcing investors to face higher smart contract risks for lower returns as regulation and exploits mount. I would say regulation is number one. The most important one is regulation. Yes, we have Terra Luna. Terra Luna dropped. Left lots of investors, like totally heartbroken. I get it. I absolutely get it. Let me ask you the question of every single investor who went into Terra Luna. Did you guys understand the risks? No, we didn't. We're small-time investors. We don't understand risk. We want, the daddy government to protect us. Please, government, protect us. Okay. If you want daddy government to protect you, why the hell did you get into the crypto space in the first place? Like, why are you going back to the daddy government to say, hey, please help? Like, don't go there. Don't go to crypto. Go stocks. Go treasury bills. Good luck with that. Buy real estate. And we're going to talk about this like in a second as well, about this kind of whole point of like what crypto is and what crypto is not. That's very, very much related to this. And obviously, like we told you, well, not you guys who are listening, but we told everybody for years, like that's exactly what's going to happen. Web 2.5 cannot compete against Web 2. Web 2 has better everything. Goldman Sachs has better everything. JP Morgan has better everything. They have staff, they have connections, they have regulatory clarity, they have all the necessary, lobbying laws, possible up their sleeves. Like they can do anything to crush the hell out of you. Circle, you're just not competitive unless Circle is owned by, by those enterprise players on the back end. Permissionless Ghost, keep saying this, for call after call. How Tether is, it's under Lutnick and Cantor Fitzgerald, which one of the, largest investment banks. That was the biggest one to be crushed, by the way, as I mentioned before, during September 11 attack. And back in the day, used to be like the best and the brightest. Maybe there was some type of something. I'm not gonna go, what we see geopolitically. So let's just read this article through. So flagship DeFi rates have fallen below traditional finance. With Aave 2.6%. By the way, 2.6% has been there for 2.6% is high. It's actually lower. It's 1.5%. Okay, well, fine. 2.6% APY. Like it didn't happen yesterday. This has been like this for the last 3-4 years already. It's just this article just summarizes it. 2.6% APY on USDC trailing the 3.14% offered by interactive brokers. And of course, if you go to treasury bills directly, you can, since Circle is kind of a representative of a dollar, you can go to, you can go and get up to 4% on certain smaller commercial banks. You can buy treasury bills directly. It's going to be 3.5%, 3.6%. That's official. Fed is not cutting, and I'm pretty sure market rates for some of these, especially longer term, are kind of higher, pointing to something much higher, pointing out to potential inflationary forces in the USD associated with the partly with the Iran war as well. Investors observing high risks, including 2.47 billion spike in 2025. Exploits, blah blah. Okay, so exploits, that's another risk, and that's true. Zeus, by the way, interestingly enough, ahead of his time, founder of Olympus, ahead of his time, said the same thing. He's like, listen, like, we have to offer competitive rates. Back in the day, he said it, I really understood, but, kind of saying in line with this article, it's on one of his podcasts, where he said, yeah, like, we have to offer higher yields because, yes, investors take in smart contract risk, which is significant. So we have to compensate for that risk. The rates in DeFi has to be higher. Organic on-chain yield has dried up. The remaining competitive rates, 3.5 to 6% now, largely depend on RWA assets like treasuries and institutional credit. Now, let me tell you, there are definitely some ways to make real-world assets RWA Web3 decentralized. There are some ways, game theoretic ways. There are definitely some ideas. Like we personally have some ideas how to do that. However, everything you see RWA is totally Web 2.5. The biggest one is, what's the project? It did grow up. Something with a C. Contagion or something. But they, I think, significantly increased their TDL. Maybe by a factor of whatever, 10 to 20. But like, it's all Web 2.5 plays. And Web 2.5 will not be competitive amongst Web 2. And just because the settlement is faster, given the regulatory unclarity globally, right? Because like, you're not, no, not Kenton. Was it Kenton? No. It's this, it's like this physics thing. It's like the physics council is how they call themselves. In any case, if you are to attract capital across the globe, right? What's going to happen is you have to have regulatory clarity across the globe, right? So let's assume you are, out of the U.S. doing some RWA project. Okay, cool. So you want to, attract Japanese capital. Okay, so you need to make sure that Japanese capital is in line with U.S. capital. You need to make sure that the regulatory and securities is clear, especially cross-border. You also need to make sure taxes are clear on that, also cross-border, and that's not clear. So you are already like in huge trouble, and therefore you have to limit yourself to certain geographies that have certain clarity, that that have all this transfer payment situation figured out, both on the security front, on custodian front, also on taxes front, and you just don't have that. And then you have BlackRock issuing ETF with all the clarity in the world already figured out ages ago. Not only they figure out the clarity, they are in charge of this clarity, right? So they want to lobby the laws. How are you going to compete with BlackRock? Just because your what's it called? Settlement is like a little bit faster, because they're also working on that. They're also increasing their settlements. Like, you're not going to be able to compete. The real thing is, you remove this regulatory thing clarity altogether. You create a pure Web3 play where you don't need that. You don't need any KYC. You don't need any ML. You're not breaking any laws when you do that, but it has to be specifically pure Web3. And obviously, it's very complicated to do that. So what is the right way to do? The right way to do is not to go Web3, not to go the difficult yet correct route, to go with the easy Web 2.5 route, tell everybody how you are the smartest shit out there your project is. Try to hopefully get some VCs. Typically, it's VCs who actually fund these projects, and of course fail, and then say, "Hey, it's AI that is really going to change the world. Blockchain is now." Okay, that's the play, and of course it's failing. Okay, so crypto investors once turned to decentralized finance for easy passive income through juicy yields are running into new reality. The numbers are no longer adding up. That's true. DeFi on-chain finance is essentially conducting banking transactions on blockchain, cutting out middlemen. Okay. Now, fast forward to 2026, Aave, the largest DeFi lending protocol, and by the way, the most sophisticated, seems like one of the most sophisticated working DAO, in line with the likes of Polkadot, by total value locked, TVL by total locked, is currently offering an APY of around 2.6%. Non-Circle deposits that sits below 3.414. By tracking brokers, we said that before. DeFi, earn 1% below T-bills and lose all your money one time per year. That's a tweet, and that's kind of exactly right. So you earn less and your risk is higher, so it makes no freaking sense. Now, how did Aave get to that? Well, Aave is also trying to do something similar, right? Like Aave is also trying to go, this Web 2.5 route to some extent, especially lately. But unfortunately, when you power, the likes of Tether and Circle to enter your ecosystem, it sounds really cool as a partnership on Twitter, but that's what happens. They should have gone towards promoting decentralized stablecoins, DAI. But now they didn't. They said, screw that, let's go Tether, the lowest hanging fruit. Let's just go the easy route. Nobody wanted to go the hardest route. Goes the hardest route. Like, it's not that, let's pride ourselves that we have, that we are doing this. But guys, like, you see how difficult it is. Like, it's very difficult. We do this not because we are masochists, like we have nothing better to do. That's the only way. Like, the hardest way is the only way. But that's the correct way. Now, of course, we can say, let's just, focus on UI, permissionless, like, we're going to pick on you a little bit, like, let's go UX route, which is Web 2.5. Most of the time, they're correlated to each other. I'll show you in a second. Let's go UX route. That's easier to attract clients and stuff, but you will be running into this situation. And now today, how many algorithmic stablecoins do we have? DAI at best, and then again, it's majorly, as you know, majorly connected to Circle as far as the backing. So now we have Ethena here. Okay, so in 2024, let's go. In 2024, DeFi yield looked genuinely competitive. Ethena, protocol that issues synthetic DAO stablecoin, by the way, also centralized. USD backed by assets and hedged through derivative positions. Sides USD product offer more than 40% APY at its peak. Okay. Ethena's APY has since compressed to around 3.5, while its total value locked has fallen from 11 billion down to 3.6. So not only, right, like they got less of the kind of back-end as far as the TVL, but also less of the actual APY. And yes, they are also pretty centralized guys over there. So to have Ethena be compared. Now we had some Terra Luna situation. Terra Luna was also pretty centralized. But again, the best example I would say is DAI. The second best example I would say is actually Frax. Where is Frax, ladies and gentlemen? What happened to that? I think it's 100 million market cap right now. Why? We had this other one, Amplifort, right? Like, that's where Olympus got its inspiration. Therefore, by transitory property, ghostDAO got its inspiration from Amplifort that was rebasing up and down. Also algorithmic. Where is that? I think the market cap is like below 100, below 40 million. Like, why didn't Aave support it? Why didn't Uniswap support it? They were taking the shortest route, and they will be screwed because of that. Let's just wait. That's unfortunately the sequence of it, because it's not because I'm like a bad person trying to, burn in hell of like, because whatever. If you don't go pure Web3 way, you will die as a project because you're not competitive against Web2. It's just truth. You can try. These guys are trying. Aave, by the way, has very good DAO as far as like how to say, from the competition. I wouldn't say they're the best of the best, they're the best of the worst, but still, the best DAO so far. It has both strategic and operational proposals, right? Although, again, Aave exists on many chains, but proposals only happen on Ethereum, which is quite interesting. So how do you launch proposals on Polygon? Well, somebody does it, right? You can guess who is doing that. But in any case, right? So that's the situation. Okay, how is that connected to anything we do? So let's not forget. So we have this permissionless ghost in particular. We had lots of conversations, and thank you so much for those inquisitive talks back in the day, specifically with you. Sparta was, part of these conversations as well. How are we different? How Ghost Bridge is different from other bridges? And like we prepared all these like different frameworks, and the latest framework was the framework before the last was if the bridge can be validated by anybody and can be monetized by everybody, it's a decentralized bridge. Those two specific conditions. So the bridge has to be monetizable by anybody and validatable by anybody, right? So it has to be a very permissionless entry point for me to become a validator. And once I do become a validator, I have to monetize it somehow through those bridge fees going to me. Thus, I have an incentive to make sure the bridge is operating properly. We don't have a single bridge like this. We don't have a single freaking bridge like this. Okay, that's the first aspect. Second aspect, second theory, or second whatever framework to identify whether the bridge is central or not, just came out recently, maybe a couple months ago, and that is very simple. who controls the liquidity pools? That's it. Let's not even ask these questions like, can you monetize it? Who is in control of the liquidity pool from which the payment is going on the other side of the bridge? So I'm sending Tether, DAI, whatever, Link, ETH, sending it to the bridge. I'm getting on Ethereum, whatever. I'm getting BNB on the other side. Who's like that smart contract that spits out BNB into my wallet? Who controls it, right? And who controls the liquidity of ETH that I just sent, right? So who controls it? Most cases, not no, it's all cases, it's a centralized party, right? So we don't even have to ask questions like who monetizes or whatever. Like if one party is controlling it, and in all cases it's the case, it's a centralized party. And then a new thing, because we are working in something governance, we may have some interesting updates next week for you guys as we are, I wouldn't say finalizing, but definitely getting more and more clarity on how the governance will be working. A little bit of sneak peek into your into your amazing Saturday is this. So we have federalism, right, in the U.S., where there's a separation between state, and kind of the power of the state and the power of the national government. And we may introduce something called chainism. So we may have, again, this is very, very preliminary, and it might not be the case and change every day, but super, super fast, and maybe we could go this route. The system of checks and balances, which will be comprised of three major players, three major actors. The first actor is validator actor. Second actor is the ghost cult, which is comprised of council and whales. And then maybe, because we need to figure out like how this works exactly, we need to run this by the council, so probably in the next couple of weeks. And then once that's finalized, then we can kind of, maybe start preparing some documentation around this. And maybe the third player is going to be the chain DAOs. Now, those chain DAOs will exist inside of the Ghost chain, so you have to bridge inside of Ghost. That is most likely the case. But the idea is to move those DAOs from ghostDAO, because initially, like we thought, maybe we just kind of built those chain DAOs on Ethereum, whatever, Binance, Polygon, into the Ghost cult. But now the idea is maybe those are separate, and that's going to be essentially they will be called probably chain DAOs. So in that case, we have three types of players, and they do have veto for various purposes to make sure the checks and balances works out. So chain DAOs can veto certain functions of the council, contingent upon there's some type of supermajority. Obviously, the council can veto, certain aspects of the validators and certain aspects of the chain DAOs, and similarly, validators and chain DAOs can also interact with each other. So, kind of trying to represent that system. And the reason why this ideas about like what crypto is covered on today's call is because when you think about governance, you kind of need to go back to the root. And what is the roots? What's the root? What is the root of crypto? The root of crypto is libertarianism, right? So why most bridges or all the bridges right now are centralized? Well, do they uphold the values of libertarianism specifically? Now, what are these values? So there's this article by Bradley Hahn. I don't know who that is. Like some random article here. I probably could have found something better. But self-ownership and libertarianism, we must fully own ourselves to be free. Now, of course, that's very, very relevant because during the Constitution, because I've been diving deeper into the Constitution. So whenever the Constitution was created, citizens had one vote and slaves had 3/5 of the vote. I think that's still part of the Constitution. Talking about how self-ownership is a new idea. It's not. It's been, less than 300 years. You don't have to own yourself necessarily. Libertarianism says, yes, you do own yourself. That's a philosophical, very, very strong philosophical question. And of course, you guys know that before Republicans and Democrat dichotomy, they were Federalists and Anti-Federalists out of those 13 states. Now, Anti-Federalists were Republicans, so they were Federalists and Republicans, right? So that's kind of the now Republicans, the old school Republicans, were vouching for smaller states, not no national state, and therefore more towards libertarianism. Now, of course, that significantly dissected into something different, or something a lot more disconnected from what it was before. But it's important to really understand what self-ownership means. We must first understand what ownership is. To most people, to own something means to have something. Most people can basically agree on who owns what and why, and then he just goes on this journey of figuring out like what is ownership. do you actually own anything? Here's an uncomfortable part. If owning something means having the absolute right to control it, then do you really own things such as your land if you have to pay property tax on it? Your business if you have to obey regulations on how to run your business? Or do you even own yourself if you cannot choose to work somewhere for less than a minimum wage? That's a philosophical debate. Now, how's that connected to crypto? Crypto is the only asset you can actually own. Now, with all this KYC ML, nonsense, absolute fucking nonsense, under the premise of, oh, bad guys will use it. Okay, how about you stop using it yourselves, you corrupt motherfuckers, out of, everywhere. In the political space, in the banking space, how about you stop using dollars for that? How about you stop, sponsoring every single dictator on the planet and then accepting their money? Because that has literally been the model. How about you stop doing that? Obviously, they're not going to do it, right? So this is for the small guys. This is to control the small guys. All this nonsense that, we're helping, through finance, we need to control the dollar. That's how we can control the bad guys. That's all nonsense. It's absolute nonsense, because then what power do we have as people, right, to control the bad banks, right? Like, listen, right? So how come, but they do have the power to control us. Interesting. Very asymmetric, okay? But this one, crypto is the only thing you can actually control. It's in your wallet. Given these, now of course we can say, well, okay, but who control? If you have no internet connection, then you don't control it. But given the fact that internet is so well developed today, practically, you can have access to your crypto. Now, what is crypto? Crypto is not even your coins. You don't have your coins in your wallet. Wallet is just UI. What happens is the database entry that you have access to through your private key holds certain number of whatever digits, right? Those digits are interpreted as coins. Now, we, through our abstract thinking as humans, we say, okay, cool. Those entry points to the database, how about we attach monetary values to those database entries? So there are no coins, right? It's just like a reflection of a database that we happen to have access to, that specific cell within the database, right? But still, very important that crypto gives us this ownership. Now, if that crypto is Tether, if that crypto is Circle, do we have this ownership? Not necessarily, because these guys can freeze it. You go to, I spoke to not on this call, but Chupa and Scorpion. I spoke, also months ago when we were discussing some other blockchains, in particular XRP, for example. Okay, so XRP is XRP, a Web3 play, because they say everywhere they're decentralized. But thing is, the validator set is so freaking centralized, it has to be 90% overlap. Like, you have to select 90% of the existing validators pre-selected essentially for you. Otherwise, the blockchain will experience lots of hard forks. So since you have to proceed with the 90% of the same validator list as, say, permissionless Ghost would, or Mr. IDK would, right, based on the transactions, like I would have the same 90% overlap. I have to, otherwise it's hard forked. Then those validators, which is significantly higher than 2/3, and therefore BFT consensus will pass through easily, those validators can easily freeze me. Although XRP does not have any freezing functions, but those validators can blacklist me like no problem. Okay, so those blockchains are also very corrupt because they're not permissionless enough. Which, of course, now you can say, well, Bitcoin can also freeze you. Yeah, sure. Good luck finding every single Bitcoin miner. And although kind of this potentially becoming more and more true, potentially, because in Bitcoin there are two major pools right now, one owned by US, one owned by China. So, well, if those two pools, right, decide to cooperate, which is very, very possible, then yes, certain addresses may be blacklisted. It's not that your Bitcoin will be frozen. It's just that transactions from certain Bitcoin addresses will not be processed. But whenever that happens, the first time that happens, I more or less guarantee that the value of Bitcoin will drop like 90%, like within a very, very short period of time. The whole point of Bitcoin is no censorship. The whole point of Bitcoin is, yes, you own your thing, right? Oh, Bitcoin is like whatever, it's a Ponzi scheme, whatever. Maybe the price of Bitcoin is overvalued, potentially. Like the monetary, maybe it's not 60,000, maybe it's supposed to be 5,000. But the utility of having self-custody, at least that has been upheld so far, that nobody can touch, is important. And that is what libertarianism is. That's what crypto is. That is the reason for high valuation, because while it sounds, cliche and whatever, unimportant, but that's very important. Privacy is an asset. I want my funds to be private. self-custody is an asset. Like it's a feature that people will be paying for, right? So if my money, say Bitcoin or Ethereum, has certain features that USD does not have, such as again privacy, self-custody, right? Massive mobility and stuff like that, and of course lots of liquidity, right? I can like change it. Then obviously there's a premium for that money. And then on top of that, you have scarce supply and blah, 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 and all these other amazing features, right? But you have kind of the properties, right, of digital money is what makes the valuation so high. And then other projects like Tether, Circle, they're just trying to get there and say, hey, we're also crypto. But you're not. You're not crypto, right? You're Web 2.5. So go compete with Goldman Sachs. Good luck. And obviously Web 3 is very difficult. So just last point on this, right? So bridges. DeFi Llama, I found out about this today. So check this out. So top bridges, obviously USDT, USDTO, right, is the first bridge. They built it recently. It's 5.5 billion. I'm like, okay, what happened to to Wormhole and the likes? Like, do they die? Oh, no. They're on the messaging protocol. So messaging protocol category, you see a Wormhole and Circle CCTP and Layer 0 and Chainlink CCIP. Okay, so I'm like, okay, what's the difference between these two? So difference is this: messaging protocol accounts for blockchain finality. You know how for Ethereum Classic you have to wait 10 hours? Okay, so these ones, centralized piece of shits, but at least you'll wait for 10 hours or so. Like at least you'll wait for certain, like this one is, how to say, like if, in bridges you don't wait at all. Bridges you just give your stuff instantly. But again, the question is like, who controls the pools that guarantee such payouts? And you also have to understand the risks. If Hyperliquid will pay me Ethereum Classic within seconds, but somebody can hack Ethereum Classic over the course of those 10 hours on an attack, then Hyperliquid itself is massive risk as a solution. Like it's bullshit. These guys just going for UX saying, this risk does not exist. Well, just wait. Let's count. Now, of course, for Tether, they probably can freeze stuff themselves. And so Tether may be an exception because they will just be, kind of transitioning into Tether themselves, cross-chain. Okay, maybe they are the exception because they can freeze account, mint more, they can do whatever the hell they want. Well, let's wait until Tether is no longer the number one kind of go-to, stablecoin, whatever. Because days are counted. Today it is, tomorrow it's not, right? Tether is 10 years old, guys. That's it. 10 years old. Things can change very fast. Bitcoin. Facebook did not exist 20 years ago, right? But guys, like, let's just have stuff in perspective. Like, stuff changes very fast. Life is long. But these guys are super risky because they're not accounting, apparently, based on the definition that I was able to find, they're not accounting for the finality on a given blockchain. So that's a major attack vector, like instant right there. Permissionless goes, who does own the liquidity of native coins we are on ramping with? We'll get to this in a second. Now, messaging protocols. So these ones are at least better. But like I would say bridges and messaging protocols based on this kind of explanation of what DeFi Llama is presenting is, okay, so if, from 0 to 10, 10 is what the solution is supposed to be. If messaging protocols is like 0.01, bridges will be half of that or 10 times worse because they like have an even higher attack factor. But overall, like that's BS. Like both of these solutions are just nonsense. But just to say, hey, how are we different from these guys? How are we different from these guys? Well, kind of the devil is in the details. Just you don't even have to go through insane definitions of of all this technical lingo from the documentation to see that who controls the pool. So let me go to permissionless ghost in a second. Who does own the liquidity of native coins we are on-ramping with? And the answer is the users. Absolutely the users. So every single time, like, okay, why do we have to bridge into Casper? Like, why can't we just bridge ETH directly into Ghost? Why can't we just create a token called Ghost, like GETH, like GETH? Well, what you have to do, every single bridge, that's why DAO is so important. That's why POL is so important. And that's why bridging fees is so important for the validators. Every single bridge will have to trigger DEX fee on an EVM and a bridging fee on the Ghost chain, thus benefiting validators. And but validators are the most beneficiary kind of group there. So if you want to bridge anything, You have your ETH, you transfer that to Casper. How? Through Treasury, through DEX, right? So now the Treasury, the ghostDAO Treasury, is working through bonds to expend the TVL on the DEX, right? But the DEX is controlled by whom? By the protocol. Who controls the protocol? The users. That's it, right? How? Through Casper receipts. So then you have your Casper token. Then you bridge your Casper token into Casper coin. Boom, the bridging is done. And on the way out, it's the same thing. So you go through the DEX as well. And you go through the Treasury as well. Now, it's not that you go through the Treasury, like the ghostDAO Treasury, but you go through the DEX Treasury. But the thing is, you have lots of, you have whatever, like top, let's assume 50, 100 projects with good enough liquidity on DEXs, and then you have thousands, probably tens of thousands of projects with no liquidity whatsoever on those DEXs. So same thing may happen with what's it called? Same thing may happen with Ghost, right? With Casper token or right on the DEX. But we do have to, using Olympus DAO mechanics, and that's why we inherited it, is using Ghost Olympus DAO mechanics, we can, through LP bonds, can significantly increase the liquidity on the DEX. That's the point. That's why we're doing it. Now that liquidity will be owned by the protocol, and the protocol will be earning DEX fees for that. So every single bridging fee leads to increase in POL and increase in bridging fees. So your Casper goes up because back end of Casper goes up, right? Because our fee goes up because DEX fees get triggered, and then the validators also earn through this, right? So and validators earn. So therefore, validators will be maintaining the network because it's every single bridging transaction makes them money, right? In a decentralized permissionless way. Very complicated infrastructure, I get it. Very, very difficult to make. Very difficult to think through it as well. Like so many kind of, I would say, gaps still exist. But listen, that's the only way we believe that this will be sustainable. User XS4 is asking, it almost feels like we need to come with a new name for what we do other than bridge, so we're not compared to the other bridges out there. Agree to rename? Yes. And ladies and gentlemen, if any ladies listening to us, that's kind of the point of stake squared, right? We remove the name altogether here. Yeah, I mean, for now, most likely what's going to happen is the bridge will probably have its own domain, bridge.ghostchain.io down the road. So remember, we have two phases. The first phase is Degen phase. Second phase is bridging phase. So the bridging phase is there once the liquidity and prices on any two chains are enough to be stable enough so the bridge is smoothless. By that time, it's going to be the same thing as the permissionless Ghost was asking, who will be controlling that liquidity? Well, the DEX liquidity, for the most part, is supposed to be controlled by the ghostDAO Treasury through protocol-owned liquidity. Okay, so, but going back to DeFi yields, we're talking about Aave has 3%. Ethena, USDE had like 40%. Okay, guys, like we have fucking 959%. And that's single staking APY. And that's not bullshit, that's real. And then these guys, we deployed Hoodi. Hoodi is live now. I'll talk about this in a second. But 69% so far. Although, when we look through this, so this is new UI. There are certain things that we need to change. Like this needs to be changed. This will show the highest discount. It's a programmatic, so it will show like whatever 80% discount here. Now this one is just 959. It's supposed to show double staking APY. If you do have Ghost Connect, it will be loading that up. If you don't have Ghost Connect, we will be calculating historical APY, which is its own calculation. That's why we have to redeploy Gatekeeper smart contract and add new things there too. But this APY will not be the same. Sometimes it will be the same, but most of the times it won't. Most of the time, stake squared will be a lot higher than that, like a lot higher, because it is higher. And that's how these are the new, we call them papers. Permissional Ghost in particular, not picking on you this time, but I know for sure that those papers before were a little bit confusing, I think. You were, and thank you so much, you were part of this inspiration for us to change it. So we can like get redirected to proper, fields here. So it's a swap here and a bond, right? And then a stake, 3 stake, and then 10 stake. So we yet need to redesign this bridging altogether. We don't like it. I like it. I actually like it a lot. Like put my heart and soul into this, but we need to potentially remove all the stats and just leave leave this kind of just this form so we can bridge it properly. As you can see, we have you don't see it. You don't see it. So Above it, so above this panel here, you guys can check it's already live. Do Shift F5. You should be seeing the version 7.15. So you'll see Casper if you connect it to the connect or not. So we have a Sepolia drop down. We also have a Casper uh, kind of menu showing whether you have it live or not. So it will be either red or green. Red, you don't have it. Oh, if you don't have it, it will ask you to install it. But if you do have it, it's either red or green. For the most part, it's green, at least for me. Now, very important, some things that we need to pay very close attention to. So check this out. So Sepolia, again, I know you guys shooting the shit, right? Like it's all testnet. We can do whatever. Okay, cool. Sepolia at $560. It was about $500. It's slowly going up. The backend right now, we need to audit reserves and need to increase the bond. We're so busy with stuff. We just don't have time to do this, but we're so busy. But the backend right now is about $45. Actually, it went up because these bonds are working really nice, and backend increased by 10%. And the price also increased by 10%. And that happens naturally. That's important. The team is not pumping it, trust me. It's you guys who are pumping it. So that's very interesting. What's more interesting is, as we mentioned before, let's go mortar. So this price was 400, even 300. Now it's getting closer to 500. The backend right now is actually $8 to $9. Last time I checked, we need to audit reserves as well to update it, but it's around $8 to $9. And of course, this ratio is significantly higher than it's on Sepolia. But what's interesting is Sepolia is not selling. Sepolia is not selling. Mortar is increasing. Okay, to remove this arbitrage. That's exactly what we thought is going to happen. And again, you guys shooting the shit. I understand. Maybe that's but that's an interesting theory. That's likely what's going to happen. The prices will increase to certain value, like essentially it will be like a realistic high, and most likely prices from other chains will be getting to that. Now, I have a second hypothesis. So I had that hypothesis last summer, and I think it's realizing, again, we're not pumping, you guys pumping it. I'm not pumping anything. It's just interesting to observe it. The second observation, not observation, but hypothesis was going to happen is CDLs. We don't have bonds on mortar, but CDLs on DEXs will likely be matching as well. In fact, my hypothesis goes a little bit longer. It's not that the eCasper price that we should be comparing all dates in the center, and that's kind of the eyes looking at that. But when we go mainnet, and even later in testnet phases, I think this price Casper shall match that price Casper as well. That's what's going to happen. So far, it's 1 to 2. Mortar is much lower. Because index is at 69%. Mortar was launched later, so index is still low. And again, there are now no bonds. We're so busy with governance right now, guys. Governance and bridge out, working on that. So I need to spend some time to do the bonds again. And of course, Hoodi. Now, this fucking thing is unprecedented. It's 4.2 million. I don't know who the freak did that. Whoever did that, great job. I'm not being sarcastic. Do not sell it. Well, I mean, you do whatever you want, but this is great. This is amazing in Casper price. I hope that the price of Casper, you guys shall all hope, especially council members, that, this price goes up somewhere high. Obviously, it's not very substantiated, not very, not very, sustainable for now. I think it's going to drop. Now, the reason why we don't have bonds is we accidentally removed the governance tab from Hoodi, so we need to reintroduce it, and after that's reintroduced, which is just a quick UX fix, we will start offering bonds on Hoodi and also Mortar. Okay, so that's quite interesting. What else to change? So we need to update, final touches on this value, this value, this value here on the papers. Potentially redesign Ghost Bridge a little bit. And there's some. Oh, by the way, I'm not sure if that bothered anybody. It was Cosmos' idea. When you click on bond, you just get redirected to the bond. No longer do you have to click. Like for those of you who know, you guys know, like even this, like those little changes have changed. So now you just click on stake. You go to stake. You go to bond. You actually go to bond, right? You don't go like whatever. So what else to change? Ghost Connect need to be slightly adjusted. Ghost Light needs to be slightly adjusted for the double stake. Those people who double stake, who stake squared, so those will be greeted on Light node to help them bond. And we need to create a new name for that. So it's not going to be something like probably lock, whatever. So you need to lock your breached Casper and then you need to renominate yourself instantly so you can actually receive those double staking rewards, right? So we are working on those user interface on Ghost Light front. We're not going to do anything else. We're just going to leave everything else like this, but we're going to kind of those initial inviting welcome pages on Ghost Light will have to be redesigned, and Ghost Connect for that purpose has to be redesigned as well with some functionality additions. And I think after this UI work for some time will be done. It's taken a lot of, it sounds like, whatever, you guys just change some names and just realign stuff. But no. We have to change smart contracts to accommodate for this. The pop-ups to get out of warm-up, out of the bond warm-up being done on the back end as well. So the smart contracts are already finished, but the user interface is being worked on right now. And I think they'll be live by Wednesday. So lots of work and focus went into that. I personally started slowly switching my focus towards governance. Again, chainism. I think that will be the thing where we have 3 separate groups with checks and balances. I checked current DAOs, and not a single DAO has anything of this caliber. So this work, the gentleman wrote a book. I forgot his last name, Cibeles or something. So George Cibeles or whatever. So he wrote this amazing paper, 40-page paper, in the beginning of 2000s about veto players. So kind of what's the difference between, like essentially like, striving democracies, republics versus other nations? Well, they have institutions, right? But essential checks and balances system. That's what, made the U.S. so genius with the Constitution. But then, what are the rules? How many players do you need to have? How many actors within that checks and balances system do you need to have? And he proves, almost mathematically, and definitely game theoretically, that you need to have 3+ players. And we thought initially that was going to be council and validators, and that could so Ghost Cold therefore. Well, council and whale, so Ghost Cold and validators. But then we tried to introduce potentially a 3rd player with proper checks and balances. And again, this is a very, very intricate, very difficult stuff because there's no comparable that we can take it from except for the real world. There's no like on-chain, Web3 players that do that. So we check throughout the DAOs, they don't do that either. So therefore, not only we'll probably be very innovative with the tokenomics, right, through this whole kind of bridge situation, but we'll likely going to introduce something very, very novel within the governance structure as well. And that's not because we want to be creative, it's because we have to be. We just unfortunately have to do this just to make sure it's a sustainable system. More on this in the next couple of weeks, and we'll definitely be scheduling calls with council very soon on that as well, once we have a more or less crystallized framework. Last comment, and then let's wrap this up. So user access just had an idea that instead of the warm-up function, which I think could be seen as a honeypot, what if bonds could be released if breached? And that's exactly what is engineered already. So that's exactly how it's done. So you are entering into the warm-up, and the warm-up, good luck with this. Like people are buying this bond. Like me personally, I have issue with releasing my bond claims, because somebody was just buying. So I have 2 more epochs every time somebody buys it. But if you are bridging it, warm-ups are released. That's exactly done. We had to work on that, re-engineering the smart contract. So we deployed on Hoodi. We cannot redeploy Sepolia and Motor. I mean, we could, but we have to redeploy the whole thing. We cannot just redeploy that one smart contract. Yeah. So any future, like say Pulse or whatever, they'll have that thing as well. But Hoodi already has it. All right. Thank you so much for your attention. See you guys next week. Have a good one. Bye bye.